Welcome to The Explainer. Now, if you've ever felt like crossing international borders with your income is just asking for a massive compliance headache, well, you are definitely not alone. Today, we are undertaking a definitive, expert-level breakdown of the exact mechanics designed to prevent double taxation for international earners. We're going to strip away all the surface-level filler and focus purely on the structural logic of international tax relief. We'll be breaking down the implicit assumptions, the highly non-obvious details, and the actionable insights you absolutely need to master this framework. Let's dive right in. So it all begins with this really foundational dilemma. You earn $1, and that exact same dollar crosses an international border. Which jurisdiction actually gets the primary right to tax it? This single question establishes the entire analytical tone of our discussion today. Think about it. If you're an international earner, you're suddenly caught between two sovereign entities, and both are claiming a piece of your financial pie. Without a concrete mechanism to resolve this, the mathematical result is just punishing double taxation, which fundamentally stifles global movement, totally disincentivizes remote work, and basically halts economic growth. So a major structural concession has to be made. To map this out, we're going to use a 6-step analytical framework today. We'll start with the principles of double taxation, move into strict qualification criteria, income categorization rules, navigating the credit limitation, exclusions and required adjustments, and finally wrap up with accounting methods and timing. All right, stepping into Section 1, Principles of Double Taxation, specifically looking at primary versus secondary rights. Before we can even start calculating mathematical relief, we have to establish why a credit mechanism is even necessary. And this framework elegantly solves that initial dilemma we just talked about by defining a global hierarchy. According to international tax principles, the jurisdiction where the income is physically earned holds the primary right to tax it. The country where you, the taxpayer, hold citizenship or permanent residency, they only retain a secondary or residual right. The implicit assumption here is that the host country's infrastructure and market actually facilitated that income generation. So to prevent unfairly punishing the earner, your secondary jurisdiction has to offer a credit system. They basically step back and say, okay, we recognize the tax you paid to the primary jurisdiction, and we'll subtract it dollar for dollar from what you owe us.
Which brings us perfectly to Section 2, Strict Qualification Criteria, or what we call the Eligibility Gateway.
Listen, you can't simply subtract a foreign levy from your domestic tax bill just because you happen to pay some money to a foreign government. There is a rigid eligibility gateway. The crucial point here is that a foreign levy has to pass 4 conditional steps, all at the exact same time. First, it has to be legally imposed directly on you. Second, it must be actually paid or accrued. Third, it has to represent a true legal liability, meaning you didn't just voluntarily overpay. And fourth, it must constitute a pure income tax. That means you didn't get a specific economic benefit back, like property rights or actual physical goods, in exchange for the payment. Value-added taxes or property taxes, they almost always fail this test. And remember, failing at even a single stage entirely disqualifies the levy.
Now, tucked inside that third step is a highly non-obvious trap. It's called the Exhaustion of Remedies. Simply paying a foreign tax is not enough to prove it was a true liability. If your home tax authority looks at your situation and determines that you could have practically obtained a refund from that foreign country using their own administrative channels, well, that unrefunded amount is instantly denied as a credit. The implicit assumption is pretty blunt. Your home country is absolutely not going to subsidize your failure to use the legal remedies available to you abroad.
Let me brilliantly illustrate how this trap works in the real world. Imagine a foreign country's standard statutory tax rate on dividend payouts is 20%. So by default, they just withhold that 20%. But an international tax treaty dictates the rate should actually only be 15%. If you just let them withhold the 20% and you don't legally invoke the treaty to get your 5% back, your domestic tax authority gives you 0 credit for that excess 5%. Overpaying beyond the treaty limit is viewed as a voluntary contribution, not a legal liability. The actionable insight here is huge. You must proactively enforce treaty rates abroad. because your home country will categorically refuse to eat the cost of your administrative oversight. Okay, moving right along to Section 3, Income Categorization Rules. Think of this as the containment system.
Once a tax officially qualifies, it has to be carefully categorized. The analytical logic here is to aggressively bucket the income to prevent cross-subsidization across entirely different revenue streams. Basically, you build silos. The general category includes your wages and services, while the passive category is for investments, and they are mathematically walled off from each other. If you generate excess credits in your general category because you had high-tax foreign wages, those credits are trapped right there. You cannot let them bleed over to magically rescue your low-tax foreign passive investments. Oh, and notice that absolute non-negotiable barrier regarding sanctioned territories? Any income originating from a sanctioned country yields 0 allowable credit, period.
Which leads us into Section 4, Navigating the Credit Limitation, or the mathematical cap. Let's de-jargonize this core mathematical formula, because this is how a domestic tax authority protects its own national tax base. You take your foreign-sourced taxable income and divide it by your total worldwide taxable income. That gives you a percentage. Then, you multiply that percentage by your total national tax liability. The result is your absolute maximum allowed credit limit. Conceptually, this fraction guarantees that your domestic authority never inadvertently subsidizes a higher foreign tax rate. They're effectively saying, look, we'll give you credit, but only up to the exact amount of tax we would have charged on that specific slice of foreign income, nothing more. Because of this, any domestic deductions or losses that shrink your worldwide income, your denominator, will mathematically alter this fraction, often unexpectedly lowering your maximum allowed credit. It's an incredibly delicate balancing act.
All right, Section 5, Exclusions and Required Adjustments. This is all about closing the loopholes. We have to shift our focus to the complex mathematical intersections that happen when you try to claim multiple distinct tax benefits at the same time. The absolute rule here is strict conditional logic. Many jurisdictions let you just legally exclude a certain amount of foreign earned income from your taxes entirely. But, and it's a massive but, if you exclude the income, you absolutely cannot claim a credit for the foreign taxes you paid on that excluded income. It is the ultimate rule against double dipping. To rigorously enforce this rule, the system uses proportional math to surgically strip out those uncreditable foreign taxes. You divide your excluded income by your total foreign income to get an excluded ratio. You multiply that ratio by your total foreign tax paid, and the result is the exact amount of tax that is permanently disqualified from being credited. So if you exclude exactly 50% of your foreign income, you automatically forfeit 50% of the associated foreign tax credits. It's honestly a beautifully brutal mathematical equalization. Now, there's also a highly implicit assumption regarding investments that we really need to unpack. Because domestic authorities usually tax capital gains at lower preferential rates compared to ordinary income, allowing a full one-to-one credit for foreign taxes on those gains would totally skew that limitation fraction we talked about. It would artificially inflate your overall credit limit. So, to fix this structural imbalance, foreign capital gains are mathematically compressed, meaning they are actually adjusted downward before they even enter the limitation fraction. Taxing a mathematically smaller amount of income at a higher ordinary rate perfectly mimics taxing the full true amount at the lower preferential rate. Very clever. Let's open up the final section of our framework, Section 6, Accounting Methods and Timing. Strategic lock-ins. The structural logic of international tax relief isn't just about what you claim. It is heavily dictated by when you claim it. You have a fundamental choice to make. The paid method tracks actual cash out-of-pocket payments during the tax year. It's flexible from one year to the next. The accrued method, on the other hand, is triggered the exact moment the foreign tax liability is legally fixed, regardless of when the cash actually leaves your bank account. But here is the critical, non-obvious catch. Electing the accrued method permanently and irrevocably binds you to use that method for all future years. The actionable insight? Careful forecasting.
While the accrued method perfectly matches the foreign tax to the exact year the income was earned, preventing messy timing mismatches, you sacrifice literally all future cash flow flexibility. Once you go accrued, you are locked in forever.
Now, because of those strict mathematical caps we discussed earlier, you're frequently going to pay more foreign taxes than you are allowed to mathematically claim in a single year. We call these excess credits. So what happens to them? Well, the system allows a strict one-year backward limitation. You can carry these unused credits back to your previous tax filing. It basically acts as a brief, immediate pressure release valve to see if those stranded credits can be absorbed in the immediate past.
But if they can't be absorbed backwards, you are granted a decade-long forward-looking window. You have exactly 10 years to strategically burn off those stranded excess credits before they permanently expire and just evaporate. This requires meticulous, decade-long tracking of those isolated income silos, and you're constantly shifting tax liabilities to ensure absolutely no money is left on the table.
And all of this brilliantly illustrates the incredible hidden complexity we've just uncovered today. We have successfully mapped out a system of strict eligibility gateways, categorized income silos, brutal proportional formulas, and 10-year tracking mechanisms, all constructed and maintained just to prevent a single dollar from being unfairly taxed twice. Which leaves us with the final provocative thought. As remote work continues to erase physical borders and global tax networks become infinitely more integrated, is the entire concept of a localized national tax authority fundamentally obsolete? Are we eventually going to see a unified global tax framework, or are we just destined for endless layers of complex mathematics? I'll leave you to ponder that. Thank you so much for joining this explainer, and keep learning.